Hello, everybody. Welcome to my solution walkthrough for exercise 1516. This is Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky, not the authors of the textbook or of Wiley. Okay, let's get the accounting party started. So over here, we have computation of retained earnings. The following information has been taken from the ledger accounts of Isaac Stern Corporation. So we've got total income since incorporation, total dividends paid, total value of stock dividends distributed, gains on treasury stock transactions, and then we've got the unamortized discount on bonds payable. And then we're being asked to determine the current balance of retained earnings. Let's just kind of recap really quickly. So with retained earnings, right, if we had a statement of retained earnings, we'd have beginning retained earnings, we would have plus net income minus dividends. And then this would give us our ending retained earnings. Okay, there also can be like error adjustments, the like, but right over here. Okay, so the following has been taken. So total, so there's no beginning retained earnings. So my net income is 317,000. Now, when it comes to dividends, whether it's a cash dividend or a stock dividend, both of those will reduce retained earnings, right? And why is that? When I pay a cash dividend, right, when I declare it, debiting dividends, dividends payable, and then over here, when I pay the dividend, I'm debiting dividends payable and I'm crediting cash. Dividend is a temporary account. It tells us what we gave back to our shareholders during the period. So dividends, when it gets closed out to retained earnings is what type of account? Retained earnings is an owner's equity account. An owner's equity account, typically it's going to have a credit balance. So when I close out dividends to retain earnings, I'm going to credit dividends to make it go to zero. I'm going to do the opposite to retain earnings. I would debit retain earnings to close it out. Therefore, it's going to decrease my retained earnings. So for the cash dividend, this is going to decrease by 60,000. Now, what about stock dividends? Well, when I do a stock dividend, right? So traditionally, you would do it at, if it's below 20% or 25%, it's considered to be a small stock dividend, not treated like a stock split. So I'm going to debit stock dividend. I'm going to credit common stock dividend receivable or distributable. And then I'm going to credit additional paid in capital common stock. Now, what happens is then when I actually distribute it, I'm going to basically debit the dividend as distributable and I credit common stock at par. And as long as it's a small stock, I'm going to go ahead and do this at the market value. So this is the cash, and then this would be the stock. So the stock dividend is going to be decreasing this amount over here by 30,000. Okay. All right. So let's look at these other ones here. Gains on treasury stock transactions. Well, if I sell treasury stock for greater than cost, what would that look like? Well, I would debit cash for whatever it might be. I would credit treasury stock. But when it comes to dealing with my own shares, I do never, ever recognize gains. Instead, I would go additional paid in capital common stock. Therefore, this does not impact retained earnings. We're going to ignore it, okay? Now, when it comes to the unamortized discount on bonds payable of 32,000, well, a discount on bonds payable is what type of account? It's essentially going to be a Contra liability account. So you'd have your bonds payable. Do it $1 million. And then I would have a discount on bonds payable and this would be a debit balance of 32,000. Now, what happens with the unamortized discount? Well, this discount eventually, when I pay off the bond, it's going to have to go down to zero, right? We want to get this thing down to zero. So what do? Well, the discount is ultimately going to be amortized to interest expense, right? So this part over here, when it comes to the discount, any type of interest expense, and this is also unamortized, means it's sitting on our balance sheet. So this is already, any type of amortized discount would already be included in the income since incorporation. So this unamortized discount is a contra liability account. It reduces the carrying value of our bonds payable. Therefore, it has no impact on our statement of retained earnings. So over here, our ending retained earnings is going to be my beginning plus the net income plus our 2 dividends, cash and stock, giving me ending retained earnings of $227,000. And just to make sure we've done this correctly, I'm going to go ahead and take a look really quickly, and let's see how we did. I think I got it right. Yeah, 227. Okay. So that's what that would look like. So I want to thank you for joining me here today on this solution walkthrough of exercise 1516. And big thank you to Wiley. So I want to thank again Wiley in all seriousness for allowing me to use these videos and make them public on YouTube. Please don't forget to like and subscribe. If you'd like to see other solutions, feel free to ask for them in the comments. Have a great day.